This past week was incredible. Thursday and Friday trading, the S&P index went down significantly both on Thursday and on Friday. What's more important to point out is it was induced by fear. There's a bank that went down. Silicon Valley Bank got taken over by the feds and is now going to be liquidated. And now just about every agency is really pushing fear. I've been investing for over 30 years, and my portfolio has grown decade after decade. And I don't buy into fear. I actually think it's a great time to look at investing over the next 2 weeks and in 2023. I'd like to share with you my week ahead, my plan, and how I've done my homework to be in a position to buy shares and stocks that I want to own, as well as bonds. Let's get into it. The fear is really moving up the ladder. And if you look at, I tend to watch Yahoo Finance. I really like watching YouTubers, people that really put skin in the game, make investments, really talk about how they invest. But I like to watch, especially when I work out, just the general news. And here's Yahoo Finance talking up the recession, how bad it's going to be, and how the Federal Reserve is driving us to recession. Jim Cramer, I also listen to him. If anything, I just like to view his passion. I get a good laugh out of him. I don't make specific investing decisions based on Cramer, but here he is talking about the Silicon Valley Bank collapse. CNN, it's gotten to CNN. And the reason I point out the big media is the fear index. As fear goes up, people stop acting rationally. They think, oh man, the sky's going to fall and so forth. And then the last thing, Face the Nation. So even to like big outlets that you can watch on just regular TV, the fear of the stock market, the fear of the recession, the economy is really hitting a high note. And what I would, remind you, during these dark periods, I'm sure Warren Buffett's going to comment and provide comments to this degree. I remember in the Great Recession that was induced by the subprime mortgage meltdown, he said, hey, I would never bet against America. He would never bet against the economy that the United States has. And I'm in that boat. I think that we are heading into a bad, economy. We're going to see a recession, but I'm buying because I believe in the US economy. I believe in the companies that I own and additional companies that I want to buy into. And I think those companies are going to be worth a lot more money in 10 years. Okay, so I wanted to take a look at a 1-year chart. There's something that I track. I track the 10-year yield because it really dictates so many things. The rate of interest for the 10-year yield tells you how much mortgages are going to be for homeowners, which is usually the biggest investment anybody ever makes. It also means, what rate will consumers and businesses, be lent money and how much interest they'll be paying. It also means the bond rates. Bond rates, if interest rates go up, the price of a bond goes down. So the yield to price relationship is there. And you can see that over the last year, it has gone up just a nice 35% degree, upward chart. And it's gone up 73%. Meanwhile, the S&P is really just, struggled. It struggled over the last year. And it's because of that relationship with interest rates, as well as I think that in 2021, the stock market was overpriced. I'm a believer of that. But I think that this relationship, this gap is what we're dealing with. And the other item that we're dealing with is the expectation of what the Fed's going to do. And the Fed has to keep interest rates high until they see inflation come down. So it's already high. It may go up a little higher. And that'll cause stock prices to continue to be volatile and be suppressed. I'm showing the 10-year treasury against the S&P just year to date. And there's a couple of reasons. First is the stock market did really well at the beginning of the year. First month, it was up 6-7%, which was great. It was fun because interest rates are going down. Okay, there is that relationship between the two. But last week, we saw both of them go down, both bond yields and the stock market went down together. And the reason for that, the one explanation is fear. That's the fear in the market right now. I don't think the fear is going to go away. I think it's an opportunity to look at companies because people are not acting rationally when they just get out of positions. They just start selling off. So let's look at a long-term horizon. I'm looking at the S&P, at the max, chart that Google Finance will give me. And there's been a lot of ups and downs. And I wanted to kind of give you context and kind of share with you my individual experience as these meltdowns have occurred. I've been investing since 1992. It's been 31 years of investing, and I'm 54 now. So back, you can do the math. When I was in my 20s, I was really looking for a long-term, appreciation of my investment. And frankly, I didn't have the experience to really feel like I knew what I was doing. So I went mutual funds and so forth. But I wanted to point out a couple of experiences that played out that really tested, I guess, my emotional state and what I did and what happened. So the dot-com bubble happened at the 1999, 2000 time period. And it was a really fun period of time. I was in college when, the internet began to kind of take flight, and it was pretty interesting. I would go online. AOL is a big company and so forth. And a lot of, junky companies started getting created, that just did these silly things online. They really didn't have a very good business model. And the dot-com bubble burst, and I was an investor in Webvan as an example. That went completely bankrupt. I lost all my money in Webvan. But I was also an investor in a lot of quality companies, Microsoft as an example. And I did not sell, in general, I did not sell any of my positions during this meltdown. I actually continued to add more money. And each year, each decade, I've added more money into my portfolio. Just over time as I work, I put more money into that portfolio. And it really paid off because over the period of time that followed the dot-com bubble, my portfolio continued to grow. Then we got into the subprime market meltdown, and that was a meltdown that was led by real estate. A lot of companies lost a lot of value. And I, again, did not sell any of the companies that I believed in. I actually invested more, and I invested more and felt like, hey, there's some companies that are really, really going to do well. And they certainly did. And from the time of the Great Recession up until really the time we hit COVID, we saw just a great appreciation. And that just built so much wealth for my family. And it was a great time to see really long-term investing pay off. We hit COVID. And again, I did not sell one position based on fear. If I didn't believe in a company any longer, then I got out of that position. But that was on fundamentals. And again, it was rewarded because once we got back on our feet after COVID, it just shot up. And now we're dealing with, I don't know what they're going to call it, the post-COVID, recession. I don't know what name they're going to give it, but we're seeing this correction again, similar to these corrections that we've seen in the past. So based on my individual experience, each one of these, I believe in the U.S. economy. I believe in America. I believe that this country will continue to thrive. I think that we're in an era when technology is doing great things and will continue to make us more efficient. And U.S. companies tend to lead in technology, tend to lead in media and a lot of different sectors. So therefore, I'm going to continue to buy, and I'm actually more involved in buying more shares in the companies that I want to own in, because I feel like now that the fear is going up in the market, I can buy the companies that I want to own at a discount. So some of my conclusions for year to date 2023 and my plan going forward, especially for this week. So first, inflation is still too high. And part of the struggle is the Federal Reserve. This is a lagging indicator, meaning they could do something today, but they don't know for 6 months if it worked. So a lot of the stuff they did 6 months ago may already be working, and inflation may be on a downward trajectory, but they don't know. So they have to continue to add pressure, and that pressure comes in interest rates. So the expectation that they're going to keep interest rates high, that causes bond prices to go down, and they've been beaten up for a year. And that's part of what led to Silicon Valley Bank losing a lot of money on their bonds. That was one of the elements that was in play. And that big loss caused, investors to not believe in Silicon Valley Bank. Like, whoa, they took a $1.7 billion loss on their bonds. And so that type of fear is in the market, and it's driven by the bond prices being beat up. But at the same time, yields are up. So remember that part. Stocks will be down significantly over the next 2 weeks until the Federal Reserve makes a rate decision. And first, between now and the Federal Reserve, making a decision, I think there's going to be a lot of good buying opportunities if you're a long-term investor. Second, the Federal Reserve will make a decision. Okay. Now, if they go 50 basis points, the market will drop a lot. If they go 25 basis points, it may have kind of a rally effect. We'll see. But I'm skeptical that we are in a long-term rally. I think we're going to trade sideways. The big story of 2023 is, rates are already high, and how high will they get? And how bad will the recession be? And recessions, again, been investing for 30 plus years and have been professionally working for 30 plus years. Recessions are a natural event in our economy. The economy cannot continue to grow over and over and over again. So if you study history, you see that recessions are a normal thing. As a matter of fact, leading into COVID, one of the thoughts that I had was, it's been too long since we had a recession. You just naturally need to have a recession for the economy to rebuild in the right places, and the right industries continue to grow. There's going to be more criticism of the Fed. You're going to see political pressure on the Federal Reserve. And the reason for it is the fear index. I think people will be in fear. They'll communicate to their congressmen, to their politicians, and those politicians will begin to put pressure on the Fed. I continue to, and you can watch my previous videos when I put my market outlook and my plan. This has been my observation for over a month, that, really the S&P is going to be volatile this year. We may end up or down 5%. And that's really what I'm expecting, this year. Right now, the S&P is just up maybe 1% or 2%, and it was up, 7%, less than or about a month ago. So it's just going to be volatile, but that's an opportunity. I'm planning to remove emotion from the equation. Don't buy into fear. Listen to stories on fear just to observe how others are acting and see how irrational they are, but really focus on the facts. What's going on with the economy? When are certain things going to happen? Because if I focus on the facts, I take opportunities and act on them. But if you really focus on fear isn't going to get you anywhere. Bonds are really performing well for me. They are providing great income. This past week, bonds really rallied, by the way. They went up in value because rates dropped so fast, the bond values went up. So I'm getting a stable part of my portfolio, and I'm getting really good income out of bonds. So I'm going to continue to, especially if interest rates go up, then bond prices will go down. I'm going to buy more bonds. And over the next 2 weeks, and really in 2023, I'm using down days to continue to buy into companies that I believe in and dollar cost average into these companies at a discount. So I have a long list of companies that I'm already invested in and want to continue to buy. And if you saw my previous videos on my stock, buying plan, previous weeks had a shorter list. And the reason for it is, as I mentioned, there's just a lot of fear out there. And I'm expecting that the stock market's going to continue to trade down. So I'm going to be buying things like Meta. I think they've had a really nice 2023. A lot of good things happening. Ford, a new investment, and I can thank another channel, Cameron Stewart, with Rational Investing. He reviewed WestRock, and I reviewed it, and it's just a really good company. So I started a small position in it and will continue to buy it. They have a really nice dividend. AT&T, I've owned AT&T for a long time, so I'm going to continue to buy AT&T. It's a good company. I've owned Vista for several years. I've gotten in and out of the position, but just a really solid company. They perform really well, and I think they're undervalued by 100%, believe it or not. If you study their free cash flow and their growth, you might agree with that. The big drop in stock prices have opened up an opportunity to invest in some e-commerce companies that I believe in. It's very easy to believe in Amazon and Alibaba. I've owned Alibaba for 4 years, and it's kind of been a stock that's let me down on many occasions, but I think their valuation now is really good. And then Amazon is Amazon. I've invested in Amazon for 25 years and was out of Amazon for a little while because I thought their stock price was way too high. Now their stock price is down, and they really have a good value proposition for me. Started buying into Citigroup. Again, another tip to my hat to Cameron Stewart, gave me this idea. And then Kroger's been an investment. You can't go wrong with food, especially as we head into a recession. Tyson, another food stock. CVS, I'm a long-term holder of CVS. Insurance, Elevance, which is, provides healthcare insurance as well as they're diversified in healthcare. Been a long-term investor in Prudential, and they had a kind of a rough couple years. And but now they really have a really solid proposition. They pay a high dividend. I think they have good upside. So I'm going to continue to buy into Prudential. Dow, really good company. They provide a really nice dividend, great run company, very good upside. And I know it kind of sounds a little counterintuitive that materials may go down in a recession, and they may, but this is a global business. And I know the Chinese economy is getting back on its feet. So there's a lot of opportunity there for Dow. A new investment that I'm excited about is Live Nation. I looked at their financials. They're growing. People are going out. They were so cooped up because of COVID. They can't wait to go to a concert. They can't wait to go see some live entertainment. And Live Nation is thriving. I think they have an upside of 52%, and I'm going to continue to buy into Live Nation. I have a small position at this point. I got out of media, did really well on Netflix. Man, that was my investment of, I think, the last 12 months. I did really well in a short period of time, but the stock price for Netflix went up so high that I had to get out of it. So I'm buying into Comcast. Comcast has a really good proposition. They pay a dividend, and I think they have really good upside. So I'm going to buy into Comcast. Next one is Pfizer. So Pfizer has so much cash on their balance sheet from the COVID boom they saw. They have a strong pharmaceutical business. This business, if you look at the valuation before COVID and after COVID, it's about the same valuation, same stock price. I was an investor in Pfizer in those days. And now they have a giant amount of cash on their balance sheet, and they have the same valuation. So I'm I have a big position in Pfizer. They pay a nice dividend, and I think they have upside. Union Pacific is a new investment for me. I have been trying to get into railroads for some time and finally found a good entry point into Union Pacific. They pay a nice dividend and they have good upside. So I'm glad that I'm in Union Pacific and will continue to buy into it. Next are two interesting REITs. First one is DLR. They do data centers for the technology industry. That's where I work in. They pay a nice dividend, a little bit of upside. And I think this is going to be a growing space for their economy. Next one's pretty risky. This is Medical Properties, and this is Fast Charts is another channel I watch, and they brought this company up, and yeah, it is really risky, but they pay a 13% dividend. The things I like about them is they're in the healthcare. So they basically have properties that are hospitals or healthcare facilities, and they rent them out. Now, in a recession, healthcare is a really good place to be. There's one property they're having trouble with. They have a tenant that's having financial trouble. Once they get that one tenant resolved, I think this stock's really going to go up nicely, and they're going to pay a really big dividend. They have plenty of cash to pay that dividend. Broadcom is an investment that I've bought into Broadcom for years and had gotten out of it. I did really well, made a good gain because their stock price had gotten so expensive, and it really came back down. And I was able to get back into Broadcom, and they pay a good dividend and have very good upside. So I'm going to continue to buy into Broadcom. Software, this is kind of a bizarre situation. These are great software companies, Dropbox, Zoom, and Idea. They're very profitable, provide great free cash. They have very good upside. And for some reason, the stock prices have been suppressed, which is interesting. I'm going to buy them because, first, I think over the long haul, they're a very good value, play that is going to be worth more over time. And I think especially these companies, their acquisition targets. A lot of their bigger companies like a Microsoft or a Google and so forth, they have so much darn cash. They can easily buy these small companies and really add a profitable growth to their overall income statement. Hewlett Packard is a very well-run company. I have done really well with Hewlett Packard over the years. I trimmed my position down to roughly zero in the last 6 months. And the reason for that was I did really well with Hewlett Packard. I needed to harvest some cash in 2022 to invest in bonds, as an example, and got out of it. But I'm building my position back up in Hewlett Packard. They pay a very nice dividend. They have very good upside. Uber is a new position for me. I've been an investor in Uber now for just months, maybe 4 months. And I just believe in their business. And now their business has turned a corner. They're profitable and they're generating free cash. I think they have some upside, but really, I think their business is going to continue to become more and more valuable. Airbnb, I operated 2 vacation rentals for 10 years, know their business as both a customer and a property owner. I'm just a huge believer in Airbnb. I think Airbnb might end up being my best stock over the next 10 years. And then United Airlines. I played the recovery play with airlines, and it's really worked out nicely. I'm up on the stock, and they're doing really well. I think United Airlines, it's already a big position for me, and I'm going to continue to buy shares if the stock price goes down. In addition to that long list of stocks that I'm watching and ready to buy, I'm also buying more as you see bond prices go down into bonds. And I'm really liking the Vanguard short-term, intermediate, and long-term bonds. And the reason for it is that it's easy to get in, easy to get out of these. The yields are really looking good. If you, again, watch my videos, a month ago, it was at around 4.3. It's already up to 4.8, yield over the last 30 days. So especially the short-term bond ETF, it doesn't, have a lot of volatility, but you're getting rewarded, at close to 5%. Intermediate, really good yield. Again, this yield has been going up. It's a little riskier because you have intermediate term, 3 to 7 years, and a lot of things can happen in that time. But what could also happen is interest rates go down because the Federal Reserve decides, hey, this recession is going to be too nasty, and they reduce interest rates. If that does, then you're a big winner because this bond price is going to go up. Same thing with long-term. Long-term is been going up really nicely. It's almost at 5%. And that's what you got to think about is if you buy into a long-term bond and you're going to get a 5% yield, and that's a yield that you can have for the next 10 years, 15 years. Yeah, interest rates may go up a little bit and your bond price may go down. I don't think they're going to go up a whole lot more from this point. If it does, holy smokes, we're going to be in a really nasty recession. But I think that you can really buy into something that can get you about 5%. Think about that, 5% over a long period of time. Hey, thanks so much for watching the video. I hope you found it interesting and got something out of it as you prepare to invest in the incoming week. Keep in mind, I'm just an individual investor sharing my experience. I make no recommendations to buy any particular stock or bond. I'm just sharing my experience as a value investor. Good luck investing in 2023.